Manhattan, September 1929. A middle-aged businessman walks into his bank on the corner of Fifth Avenue. He has no specific reason to panic. The market is still at its peak, newspapers write about a new era of prosperity, his broker assures him this is the perfect time to buy. But something inside tells him, it's time to get out. He approaches the teller, presents his passbook, and says, "I want to withdraw everything." The teller, without batting an eye, counts out the money. 45 minutes later, the man walks out of the bank with $12,000 in cash in a leather briefcase. This is his savings from 10 years of work. Tomorrow he'll sell his stocks, physical certificates stored in a safe at home. He doesn't need permission. He doesn't need a processing period. The system allows him to act instantly. 2 days later, on October 24th, the crash begins. But this man is safe. He has his money, and he can survive the storm. Now imagine trying to do the same thing today. You feel the same anxiety. The market is at historic highs, the Shiller ratio has reached 40:15, higher than before the 1929 crash, higher than before the dot-com bubble. Insiders are selling shares at record speed, 23.7 sellers for every buyer, the highest ratio in 20 years. The yield curve was inverted for over 2 years. All signals are flashing red. You decide to act. You open your 401k app, where $180,000 sits, the result of 15 years of contributions. You click Withdraw Funds. The system shows you the calculation, 10% IRS penalty plus 22 to 32% federal income tax. From your $180,000, you'll receive $102,000 to $122,000. The system will eat $58,000 to $78,000 for the privilege of accessing your own money. But even that's not the worst part. To understand how radically the system has changed, you need to understand how it worked then. In 1929, the financial system was simple and direct. It wasn't designed to protect you, but it also wasn't designed to trap you. Savings. Your money physically sat in the bank. You came in with identification, showed your passbook, and the teller retrieved your money from the vault. If the bank had $500,000 in cash and you wanted to withdraw $12,000, you got it. Right now. The process took 30 minutes to an hour depending on the line. Stocks. When you bought shares, you received a physical certificate, a beautiful document with seals and signatures. You kept this certificate at home or in a bank safety deposit box. When you wanted to sell, you brought the certificate to your broker, he found a buyer, the transaction was executed, settlement occurred in 3 days. No intermediaries, no custodians, no electronic records that can be frozen or suspended. Margin trading. Yes, leverage existed in 1929, and it was aggressive, 10% your money, 90% borrowed. That's what triggered the crash. But the margin call was honest and direct, price falls, broker calls you and says, deposit money or we'll sell your shares. You could deposit cash from your wallet. You could sell shares yourself and settle. The system didn't block your actions, it demanded action from you. Bank failures. When banks collapsed in 1929 to 1933, the problem wasn't that the system blocked access to money. The problem was that banks had issued too many loans, depositors began withdrawing en masse, and the physical cash ran out. The bank couldn't give you what it no longer had. It was an honest failure, resources exhausted. The key idea of this world, the problem wasn't that the system prevented escape. The problem was most people didn't see the danger until it was too late. After 1929, regulators and financial elites drew conclusions. But not the conclusions they tell you about in textbooks. The official version says, we needed to protect depositors, prevent panic, stabilize the system. The real goal was different, eliminate ordinary people's ability to trigger bank runs by withdrawing their money en masse. Every reform from 1933 to 2010 had one hidden function: to create an architecture of delays, penalties, and barriers that make mass withdrawal physically impossible. Let's look at three primary traps. Trap 1, the retirement cage, 401k, 1978. In 1978, the U.S. Congress passed an amendment to the tax code creating the 401k system. Officially, it was a way to give workers tax benefits for retirement savings. In practice, it was the largest operation in history to lock up middle-class capital. Today, over $7 trillion is locked in the 401k system. You contribute money throughout your working life, 20, 30, 40 years. This money is automatically deducted from your paycheck and invested in the market. But when you want to withdraw it before age 59. 5. The system activates a penalty wall, 10% federal penalty plus ordinary income tax from 22% to 37% depending on your tax bracket. Total, you lose 32% to 47% of your money for wanting access to what you earned and saved. Imagine if the businessman from 1929, when he decided to withdraw his $12,000, had lost $5,600 as a penalty. He would never have done it. The system would have trapped him. Trap 2, time locks, processing period. Even if you're willing to pay the 35 to 45% penalty, you won't get the money immediately. The processing period for withdrawals from 401k or mutual funds is 7 to 10 business days under normal conditions. These aren't technical limitations, these are deliberately built-in delays. But here's what makes this truly dangerous: during market panic, pension fund administrators have the legal right to completely suspend redemptions. In 2008, major providers like Fidelity and Vanguard temporarily restricted access to online accounts during moments of extreme volatility. The money was there on the screen, but you couldn't access it. Now imagine a crash scenario. The market drops 10% in one day. The next day another 12%. You submit a withdrawal request. They tell you, 7 to 10 business days. But during those 7 to 10 days, the market falls another 25%. Your $180,000 becomes $120,000. By the time processing is complete and you pay the 40% penalty, you're left with $72,000. You lost $108,000 not because you made a bad investment decision, but because the system physically wouldn't let you act in real time. Trap 3, bank cash limits. Even if your money is in a regular checking account, not a retirement fund, try physically accessing it. Under U.S. law, banks must report any cash transactions over $10,000 to the IRS. This isn't a prohibition, but it creates a paper trail and potential questions. But the real restriction is even harsher. ATM withdrawal limits typically range from $500 to $1,000 per day. If you have $50,000 in your account and want to withdraw it all in cash, you'll need 50 to 100 separate transactions, one per day. That'll take 2 to 3 months. You can go to a bank branch and request a large cash amount. But most branches don't hold more than $50,000 to $100,000 in physical cash. If you want to withdraw $200,000, you need to notify the bank several days in advance so they can order cash from the central vault. And during a crisis, when thousands of people try to do the same thing, this system breaks down instantly. Now let's dive deeper into more complex financial instruments, where the traps are even more sophisticated. Trap 4, ETFs and the illusion of liquidity. ETFs, exchange-traded funds, were created as a liquid alternative to mutual funds. The idea is simple: the fund owns a basket of assets, stocks, bonds, commodities, and you buy a share in this fund on an exchange, like a regular stock. Theoretically, you can sell your share in seconds. But in March 2020, when markets crashed due to the COVID-19 pandemic, over 200 ETFs simultaneously began trading at a 10 to 20% discount to the value of their underlying assets. This means, the fund owns stocks worth $100 million, but the market price of fund shares dropped to $80 to $90 million. Why? Because the mechanism for creating and redeeming ETF shares broke down. Market makers, companies that provide liquidity, stepped back. The system that was supposed to ensure instant exit froze precisely when people most wanted out. You didn't lose access to your money completely. But you could only sell your shares at a huge loss, not because the assets themselves depreciated that much, but because the ETF market broke. Trap 5: Mutual funds and illiquid assets. Mutual funds have even stricter limitations. The SEC, U.S. Securities and Exchange Commission, allows funds to hold up to 15% of assets in illiquid instruments, those that can't be quickly sold without huge losses. When the percentage of illiquid assets exceeds this threshold due to mass redemptions, the fund has the right to completely suspend share redemptions. Classic example, the British Woodford Equity Income Fund in 2019. When investors began withdrawing funds en masse, the fund couldn't sell assets fast enough. Withdrawals were frozen. 3.7 billion sterling was locked up for over 3 years. When the fund finally liquidated in 2022, investors received about 70 cents on the dollar. These people didn't invest in risky derivatives. They invested in a standard equity fund, what's considered a conservative part of a middle-class portfolio. Their money was there on paper, but they couldn't access it. The system trapped them. Trap 6: REITs and private equity, 7-year locks. Real estate investments through REITs, real estate investment trusts, and private equity became popular over the last 15 years. Financial advisors recommend them as diversification and inflation protection. But most non-traded REITs and private equity funds have lockups, periods when you cannot withdraw money at all. Typical term, 5 to 7 years. After that term, you need to submit a redemption request, which can be processed in 90 to 180 days. But if too many people submit requests simultaneously, the fund institutes a redemption queue. You get in line and wait your turn, which can stretch for years. Your money is locked not in regulatory traps, but in contracts you signed yourself. But they didn't explain that these contracts are specifically designed to make mass exit impossible. Now that you understand the architecture of traps, let's talk about why the next crash won't just be a repeat of 1929, but something much faster and more destructive. Factor 1: Speed. Algorithms instead of people. In 1929, traders shouted on the exchange floor, transactions were recorded manually, information spread through phone calls and telegrams. The crash stretched over weeks, from October 24 to mid-November. The market lost value in waves, with pauses between them. Today, 70% of trading volume is generated by algorithms. These aren't people making decisions. These are computer programs coded to execute orders according to predetermined rules. When a certain threshold is breached, for example, the S&P 500 drops 5%, algorithms automatically begin selling. This triggers a cascade. Sales by one algorithm breach the next threshold, which launches the next wave of algorithms. In March 2020, the S&P 500 fell 34% in 23 days. This was 6 times faster than the 1929 crash. And this happened at a moment when central banks intervened more aggressively than ever in history. The Fed launched QE4 quantitative easing program exceeding $2 trillion. Imagine what will happen next time when central banks' ammunition is exhausted. Factor 2: Hidden leverage, derivatives and CLOs. In 1929, leverage was visible and simple. 10% your money, 90% broker's loan. You knew exactly how much you owed and when the margin call would come. Today, leverage is hidden in complex structures. Derivatives, CLOs, collateralized loan obligations, synthetic CDOs. These are financial instruments that create leverage of 20, 1, 50, 1, sometimes 100, 1. But this leverage doesn't show up on your brokerage statement. It's buried in the balance sheets of banks, hedge funds, pension funds. When this leverage starts unwinding, it creates chain reactions. One fund can't meet a margin call. This forces the bank to sell collateral assets, which triggers other funds that are forced to sell, which launches algorithms that sell even more. In 1929, the crash took months. Next time it will take hours. Factor 3. Exhausted tools, ammunition depleted. After the 2008 crisis, the Fed launched a series of quantitative easing, QE, programs that collectively pumped approximately $5+ trillion into the system. Interest rates were lowered to zero and stayed there for almost 10 years. This saved the system but exhausted the main tools. Now, at the end of 2025, interest rates have already risen to 4 to 5% to fight inflation. The Fed's balance sheet is still bloated. U.S. government debt has exceeded $35 trillion. When the next crisis comes, central banks will have no room to maneuver. The FDIC, Federal Deposit Insurance Corporation, has about $125 billion in reserves to cover $5 trillion in insured deposits. That's a ratio of 1.2%. If three major banks collapse simultaneously, the deposit insurance system breaks down. The most informed market participants are already acting. They're not issuing press releases. They're not warning you. They're just quietly leaving. Evidence 1, Corporate Insiders, Record Sales. In the fourth quarter of 2024, the ratio of sellers to buyers among corporate insiders in S&P 500 companies reached 23.7 to 1. This is the highest figure since electronic records of insider trades began in 2004. The previous record was 23.6, 1 in the second quarter of 2021, right before the market entered a volatile phase. These aren't retail investors panicking over news headlines. These are CEOs, CFOs, board members, people who have direct access to financial statements, forecasts, internal analytics of their companies. They see revenue slowing, debt loads becoming unsustainable, margins compressing. And they're selling. The average investor sees their companies on CNBC, where these same CEOs smile and talk about strong fundamentals. And the CEOs themselves are selling their shares. Evidence 2, Sovereign Wealth Funds, Exit from Risk Assets. Sovereign wealth funds, such as Norway's government pension fund or Abu Dhabi Investment Authority, manage trillions of dollars and invest with a 30 to 50-year horizon. They don't engage in short-term trading. When they change allocation, it's a signal of structural change. In 2024, the Norwegian fund reduced its equity share in the portfolio by 18%, increasing bonds and gold. Abu Dhabi increased its position in physical gold to levels not seen since 2008. These aren't institutions that panic. These are institutions that see macroeconomic data unavailable to the public and are preparing for a storm. Evidence 3, Treasury Market, Liquidity Breakdown. The U.S. Treasury bond market is the foundation of the global financial system. Trading volume is hundreds of billions of dollars daily. It's the most liquid market in the world. When this market begins showing signs of stress, it's a systemic problem. In October 2024, bid-ask spreads on Treasury bonds began widening. Large orders started creating 15 to 20 basis point swings instead of the usual 2 to 3. This means major players can't enter and exit positions without significant price impact. Liquidity is disappearing. When the most liquid market in the world starts behaving like an illiquid one, it means major players no longer want to hold these assets but haven't started selling en masse yet. They're waiting for a trigger. Beyond insider and institutional behavior, the numbers themselves are screaming that something is wrong. The Shiller PE ratio, 40. 15. The Shiller PE ratio measures the ratio of stock prices to average earnings over the last 10 years adjusted for inflation. It's one of the most reliable indicators of market overvaluation. As of December 2025, this ratio stands at 40. 15. For context, before the 1929 crash it was around 32. Before the dot-com bubble in 2000, around 32. Now it's 23% higher than both historical peaks. The average level over the last 150 years is about 17. We're 2.5 times above the historical norm. But Wall Street analysts explain this as a new era, artificial intelligence, technological breakthroughs, structurally high profitability. The same words were used in 1929, new era of prosperity, and in 2000, the internet changes everything. Yield curve inversion, 27 months. Yield curve inversion, when short-term government bonds yield more than long-term ones, has historically preceded every U.S. recession over the last 70 years. The yield curve was inverted from October 2022 through August 2024, over 537 trading days, the longest inversion on record. Typically, after inversion, recession occurs within 12 to 18 months. We're already well past the normal lag time. Many analysts say, this time it's different. The inversion didn't work. But the problem is, every time people say, this time it's different, that becomes the reason for catastrophe. They relax at the very moment they should be most vigilant. All these warning signs are flashing red at the moment when the trap architecture I described is fully operational and ready to slam shut. Let's return to the businessman, September 1929. He survived. He preserved his wealth. Not because he was smarter than others. Not because he had insider information. He survived because he acted before the crowd understood the danger. And most importantly, the system allowed him to do it. He didn't need permission. He didn't need to wait 7 to 10 business days. He didn't need to pay 35 to 45% penalties and taxes. The system didn't block his actions, it simply didn't protect him from his own decisions. It was a system where you could save yourself if you saw danger. Now look at your situation. You see the same warning signals. The Shiller ratio is higher than ever. Insiders are selling in record volumes. The yield curve was inverted longer than before any previous recession. Algorithms are ready to launch cascading sales. Hidden leverage awaits its trigger. Central banks have exhausted their tools. But unlike that businessman, you can't just take your money and leave. Your wealth is trapped. $7 trillion in the 401k system behind penalty walls. Mutual funds that can freeze withdrawals at any moment. ETFs that lose liquidity precisely when it's needed most. Bank limits that make mass cash withdrawal physically impossible. Processing time delays that stretch your attempt to escape over weeks while the market falls by tens of %. The system was specifically designed to trap you inside at the very moment you most want to exit. But you still have a choice. At least partial. You can reduce your 401k exposure, even if it means paying penalties now when the market is still high, instead of losing 60 to 70% in a crash and then paying penalties on what remains. You can build cash reserves outside the retirement system. You can pay attention to what insiders do, not what they say. You can diversify into assets that don't depend on the banking system functioning, physical assets you control directly. Or you can do what most will do, trust the system. Believe analysts who say, this time it's different. Believe financial advisors who say, stay long-term. Believe central banks who say, we have everything under control. Your grandfather in 1929 could grab his money and run. You can't. Not anymore. But you can still prepare if you act before the crowd realizes the danger is real. Because when everyone tries to leave simultaneously, the gates close, the systems freeze, and the wealth you thought you had becomes just a number on a screen that shrinks hour by hour while you watch, helpless and unable to act. The choice is yours. The timeline is closing.